You know, this January marks 10 years in Brian Moynihan's tenure as CEO of Bank of America. The stock has more than doubled in that time and is now hovering near its 52-week high. Joining us right now to talk about the health of the economy, the banking industry, and his views on corporate responsibility is Bank of America CEO Brian Moynihan. And Brian, it's great to see you here.
It's great to be here again, Becky, in this wonderful setting.
It is.
Beautiful.
You know, I can't believe it's been 10 years that you've been in charge of Bank of America. In some ways I can, because so much has changed at the bank over that period of time. I guess I'd ask you, 10 years later, I mean, when you took over, we were still in the midst of the financial crisis trying to deal with what was happening at that point. What's your outlook on where we are now, where banking is, and where Bank of America is? Well,
time flies when we're all having fun. So if you think about the company, we're well positioned. We just came off a record earnings year from an operating basis. That's on top of the year before. The customer scores, the teammate scores, the shareholder returns, everything's in good shape. And we're delivering it the right way, we think, in terms of the themes of Davos, in terms of delivering for the broader society and things like that. As you look ahead, we're constructive on 2020. Our team thinks the U.S. will grow at 1.7%. What we see inside our customer base is the customers spent through last year increasing during the year, and it started off to a good shape in January here as we see the reports coming out weekly. So if the U.S. consumer's in good shape, that usually bodes well for the rest of the U.S. economy just because that sheer volume. And we see about $3 trillion a year of spending go through our customers' accounts and just see that rise about 5% year over year plus. When
I talked to you in August, we got the chance to catch up with you, and you said that a recession did not look like it was anywhere on the horizon at that point. There were so many concerns about it at that point in the market. What do you see right now?
Well, at that point, you remember the yield curve inverted and everybody went to the conclusion, and then it didn't happen. And I think as we think about the market, Joe said earlier, even though you move up and down in a day, you're sitting on sort of very high highs and things like that. But what's coming under it is the underlying earnings streams of companies are still strong. The combination of regulatory reform, tax reform, the ability of people to adjust to some of the uncertainties that were occurring, whether it was Brexit or trade wars, are now settling down with a phase one deal and the USMCA proceeding through. These are good things to get out of the way so businesses are more aggressive. The big negative last year was that businesses were conservative during the year because they kept trying to read the uncertainty, and you felt that heaviest in August. Coming after Labor Day, you could see that stabilize, and they've been in pretty good shape. And we'll have to see how they react to the good news of the last 3-4 weeks of major things getting done. And
too early to really tell after the trade deal at this point if businesses are ready to really spend more aggressively?
I think they flattened out, as it came down during the year. But I think you have to think about the different types of businesses. Small businesses which are exposed to the U.S. and the U.S., they're aggressive in going out and hiring people and doing good things and spending. As you got the largest companies that had to deal with repositioning supply chains and issues like that takes energy away because you're doing all that work, yet you're not doing one new product, one new service, one new capability for a company, for your customers. So I think it really was related to the size of the company, and hopefully with the settling down of the open conflict of debate about tariffs and things like that, you'll see that mitigate.
But Brian, you can make a case that the earnings improvement across the board justifies where stock prices have gone, because I've seen in recent weeks more and more people drawing charts of the re-expansion of the Fed balance sheet and the move in the stock market as if it's totally related to the recent moves by the Fed, and that's a way of saying this isn't real, we're out over our skis. You think that there are underlying fundamentals that justify that?
Well, how did you feel in the middle of 2018 when the last time the short-term rates were here, and then we had an expansion of the market after that? So it's really going to come down to the earnings growth, and our team is constructive, whether it's Chris Heisey, who's been on your show many times, or Candace Browning-Platt and the research team on the institutional side. It's going to be an earnings growth driven outcome, and valuations have moved up dramatically. Our stock is still cheap, and the financial sector is still cheap relative to the industry, but that's a given.
And you're buying back.
And we're buying back a lot. But I think the debate will be had. But I think people extrapolating from correlations, you got to be careful, because the last correlation we had was back in August when I was talking that, we're going right into recession, yet no economist you talked to had a prediction for recession in 2000.
So then was it a mistake for the Fed to do what it did?
I think the mistake did what they should have done, which is to provide a safety net, as the chairs called it, or insurance or whatever, and you can look back to the precedents of Fed, and they've been clear about where they stand. But as long as employment stays strong and wage growth is picking up, and that's the good news for the U.S.
Would you raise interest rates?
I think they're going to hold, and I think
No, I think they are going to hold. But do you think
our predictions are going to hold? And
do you think that's a mistake?
I don't guess what they do. It doesn't really help.
You
They're his regulator.
You saw Dalio's notes that there's not a central banker in the world that wants to preempt inflation at this point.
No, I know.
So we're in big. Yeah. No one's going to do it. So we're going to get out. We're going to mess up by letting the pendulum swing too far.
And that's the question.
And that is the debate, and we'll find out probably in 5 years whether that happened or not.
You have a good story. You're in Davos now, and I'm surprised you admitted to doing buybacks. Have you got your story together on why, in your case, buybacks aren't some horrible way not to take it out of employees' pockets and put it back in shareholders and CEOs' pockets?
Well, let's think about that. Last year we bought back a lot of stock, and what did we do? We went to $20 an hour for minimum starting wage in our company beginning this quarter. Mm-hmm. 2 years ago, a year ago, I told you it was going to take us 2 years. We did it in 1 year. We did $1,000 special bonuses in cash to everybody under $100,000. We did shares above that. We just had a large bonus pool that will pay out over the next few weeks. So we're sharing success with our teammates. We've generated record amounts of small business loans, or the largest small business
What's
lender.
the justification for the buybacks? So I'm sure you could have found
we can run the
ESG
business.
stuff that would have been a better use for the buybacks.
This is a hard sort of conceptual debate.
Playing devil's
but
advocate.
our issue is not capital. Our issue is expense dollars. And so
banks are over capital.
Yeah, and so we have more capital. And what we're using is the excess capital we built up in the early part of the decade that Becky referenced earlier, and giving it back to shareholders. And that's what we're up to. So we can both do buybacks and deliver what society needs from us, from our teammates, from $250 million charity, $5 billion of low and moderate income housing, hired 6,000 people from low and moderate income neighborhoods. If that's not a great track record, and we're doing buybacks, the point is you can do both if you manage both outcomes.
We're going to hear from the president in just about 20 minutes. Is there something you want him to say?
I think predicting what comes out of Davos.
Not predicting
is
what he's going to say, but is there something you'd like him to say?
Well, I think the idea of keeping work on the trade deals so that the global economy can continue to function with more certainty, I think would always be a good thing. And I think the resolution with China, the USMCA, is starting to move through the system, and ultimately something has to happen with Europe and other countries because we need a tax deal with France. These are all important pieces that fall into
place. Is going to come on here in a second and say that was a transformative deal in China, not just a truce where we stop hitting our head against the wall and just arrive at some truce, but actually transformative in terms of changing the way we do business with China in a positive way. Do you agree with that?
I agree it's a positive thing to get the deal done. I'll let
just to get it done, or was there
predicting
something
what the president's going to say and predicting what Steve's going to say are probably both dangerous.
They might be on the same page.
Yeah, they might be on the same page.
Well, you are also the head of the International Business Council, and I know that you've been looking at a lot of the things that have been circulating through Davos, talking about sustainability and other issues. I think you have some news about what Bank of America is up to with some of those issues right now.
Yeah, so we have had a commitment to environmental sustainability for a long period of time. The word sustainability is used in the Davos context, a broader one. I'll come back to that. But when I became CEO, we had a commitment, I think, $25 billion. We doubled it to 50. 4 years ago, we went to $125 billion, and we completed it in 4 years. It was a 10-year commitment. So given that, we've now announced a $300 billion commitment over the next 10 years. To make sure we can do that on a business basis and drive the business, Ann Finucane, who runs a lot of this for us, our ESG work and everything, this team with Tom Montag, who runs the business, in the Sustainable Markets Council, because the business opportunity to deploy that money is huge, whether it's green bonds, whether it's different types of financings for solar installations, wind installations, and different technologies is tremendous. And so every business has to give to the office in order to get $300 billion done. So whether it's small businesses making a transition, medium-sized business, or large, getting to their carbon neutral commitments, we can help them finance that. And so we need the whole company to be driving at it, and Ann and Tom will drive that for us.
Between what you're doing and the kind of things you're hearing from Larry Fink, do you think it's actually going to change the way business operates? Meaning, do you think that companies are actually going to fundamentally change because they want a better score from Larry and because they want a loan from you?
Well, it's even deeper than that. It's that we have to get, what we're working with the International Business Council is to define Klaus's vision of stakeholder capitalism starting 50 years ago through all the derivations. The BRT statement, the 2017 signature by all of us that we're going to support the SDGs, the 2015 SDGs. So what you're trying to say is you can deliver profit, you can deliver success for customers, employees, and shareholders, and you can deliver on the society, the SDGs. And so we're defining the metrics to judge that. That ought to allow owners of assets managers like Larry Fink of assets, and operators to say success is along this dimension. So to give you a simple way to think about it, Klaus and I sent out a letter with Fiki to everybody saying, what date are you carbon neutral and can you commit to it? And if all the companies, our partners at Davos, commit to carbon neutrality, we're carbon neutral as of this year. Matter of fact, we made it year end. That will help drive the demand for the alternative energies that the power companies need to get them carbon neutral. And so that kind of iteration by having a simple set of 22 metrics is what we're shooting for.
Is that a message that resonates with investors?
It does, because to Andrew's point, as you go into investors now, the people that own the assets, our $3 trillion at Merrill Lynch, $25 billion of it's already in ESG funds and more of it's going there. But all investors are saying, hey, I want you to invest in companies who are doing the right thing by society.
Isn't there a cost to all of this? And the reason I say that is for you to be carbon neutral, you're buying carbon credits from other people. And it effectively means that long term, everybody can't buy carbon credits because there's not going to be enough of it, right?
Right, but this is why the power companies have to make the real progress, because at the end of the day, the power generation scheme has to.
It has to work though too, Brian. I mean, the Journal had a great editorial on this on whether down the road, a lot of IPC forecasts were way overstated on what the warming is going to be. If they're wrong about how serious it's going to be in the next 20, 30, 40 years, and you're forcing a move into renewables where gigawatt prices is twice what it should be, it's going to hurt developing countries, it's going to hurt everyone, it's going to hurt shareholders, and making these decisions, it's going to have consequences. Being woke is going to have consequences if it doesn't work out right.
So the key is to think about that balance and let companies, let the industry and their owners drive it, as opposed to having it mandated.
Right.
Whether we're going to be right 50
Andrew,
years out will be
BlackRock voted against 80% of climate initiatives in process.
I did see that.
So, I mean, it sounds great. We're in Davos and everybody's talking the talk, but
I get that. People say, "Isn't this greenwashing?" I said, "Which part of $300 billion do you understand is not greenwashing?" I mean, this is not some small thought process, and it's a business force, and so we do a lot of business. So the point is,
we'll see what happens. Like the guy who's going to talking about an hour likes to say, "We'll see what happens."
He has a very different view of all of this.
He does. He does.
Okay.
Economic sustainability. Just don't forget that.
We knew record profits and delivering that.
Good job. Kudos.
Hopefully that's good enough for you.
Kudos, Brian. I don't know. You'll never live up to your brother's expectations. That's all I know.
I'll never live up to yours either.
Yeah, that's right.
Brian,
you want to?
Very much for joining us today.
Aspire.
Brian Moynihan.
Aspire.
Thank you.
Enjoy your Davos, guys.
Hey, thank you.
Thank you.
Appreciate it.